Hey friends, welcome back to my channel. If you're new here, my name is Bianca, and recently I had a viewer who reached out to me asking a pretty interesting question, and that is, how should we value companies that own a lot of physical stuff? And when they mean by stuff, I'm talking about asset-heavy businesses such as solar farms, telco towers, or companies with massive property portfolios. So the big question was, should we judge these companies based on their EBITDA or earnings before interest, taxes, depreciation and amortization, I know it's a mouthful, or their profit after tax, PAT? And I thought it's a topic worth discussing because these two numbers can sometimes tell very different stories about the exact same business. If you look at the wrong number, you might accidentally think that a company is a gold mine when it's actually a struggling one. Or there could be a non-zero chance that you pass on a total gem simply because it looks unprofitable on paper. So in today's video, we're going to dive a little deeper into why these asset-heavy companies love EBITDA so much, why Warren Buffett himself thinks that that's a huge mistake, and how I personally use both of these numbers, EBITDA and PAT, to evaluate REITs. So before we get started, let's get these definitions out of the way first so that we're on the same page. Okay, so to begin with, profit after tax or PAT is what we call the bottom line. It's basically the money a company has left after every single bill it's paid. So we're talking about employees, electricity, interest on loans and taxes. Crucially, it also includes this pretty important thing called depreciation. Now, depreciation isn't exactly a check that the company writes. It's more of just an accounting move to show that equipment and buildings wear out over time. And this final number, PAT, is what's officially left for the company owners, aka the shareholders. EBITDA, on the other hand, is a little different. Okay, so yeah, I admit, it's a little bit of a mouthful, but just to regurgitate, it stands for earnings before interest, taxes, depreciation, and amortization. So now, instead of looking at the final leftover cash, EBITDA focuses on how much money the business makes from its actual day-to-day operations. To find it, you basically need to take the net profit and add back these four things, as how the name suggests: interest, taxes, depreciation, and amortization. And for companies with millions of dollars invested into their infrastructure or assets, these add-backs can be pretty massive. And that's why there is such a big debate. One number shows the final result, whilst the other number shows the strength of the business before the bank and taxmen take their cut. Now, to understand why companies such as telco tower operators focus so much on EBITDA, we need to take a step back and look into the massive gap between when they spend their money and when they report it. When a company builds a telco tower, they spend millions of dollars upfront. But accounting rules don't let these companies record the entire cost as an expense immediately. Instead, they have to list the tower as an asset and then spread the cost across its useful life. So that's usually about 20 to 30 years. This yearly slice of the cost is what we call depreciation. Okay, so this is where things can get a little confusing. Because that cost is spread out, the income statement would thereby record a depreciation expense every year for decades, although that tower has technically been paid for years ago. And since this charge is subtracted from the company's income as if they were fresh expenses, this will pull down the profit after tax on paper. As a result, a tower company might be raking in millions in cash, but its profit after tax may look tiny just because of these accounting entries. So this links to the point where investors who love EBITDA would argue that if you only were to study the profit after tax of a company, you would then be distracted by the ghost of the company's old spendings. Basically, they think EBITDA gives a clearer picture for two key reasons. First of all, EBITDA can help to show if the assets actually work, meaning to say that EBITDA can tell you if those telco towers are making more cash than they cost to maintain today. If that number is growing, the core business is healthy. On top of that, EBITDA also allows a fair comparison. So in these kinds of industries, some businesses may use large bank loans, while others use their cash. EBITDA essentially, as how its name suggests, ignores how those towers were paid for, letting you see who has actually the better and more efficient assets on a level playing field. Ultimately, for asset-heavy businesses, EBITDA is actually quite a useful tool for you to look past the accounting noise and to understand the true cash-generating ability that a business has right now. That said, while the case for EBITDA is pretty strong, we also need to look at the flip side, which is the case against EBITDA. Basically, we need to consider the risk of ignoring some of the costs that EBITDA does not cover. And this is where the legendary investor himself, Warren Buffett, comes in. He famously argues that using EBITDA can be a dangerous way to value a business because they treat real invisible expenses as if they don't exist. Basically, Buffett's main beef is with depreciation. Earlier, we talked about spreading the cost of a telco tower over many years. While it's true that cash is spent on the tower in the past, we also have to acknowledge that these towers are actually wearing out every single day. Eventually, these assets are going to break down or maybe even become obsolete. So these companies would then be forced to spend millions of dollars again to replace them. So by adding depreciation back to the profit, EBITDA essentially pretends that the equipment can last forever. So in other words, ignoring depreciation expense is kind of like ignoring the fact that your business is slowly aging. This leads to two major risks. Number one, it hides the burden of debt. So since EBITDA ignores interest, it can make a company with massive loans look way healthier than it actually is. A business might report a great EBITDA, but if every single cent of that goes into high interest bank loans, there's actually no actual profit left for you. So in a massive market downturn, that hidden debt could lead to bankruptcy. Second of all, it masks the cost of staying alive. So this is pretty important, especially for infrastructure companies, because the equipment is their business. If you don't account for wear and tear, you're essentially ignoring the cost of your own survival. So overall, looking at EBITDA is kind of like watching a car speed, but without checking the fuel gauge. It tells you how fast you're moving right now, but not really about whether you're going to be able to reach your final destination or not. And that's why many conservative investors may prefer the bottom line profit, or profit after tax (PAT), because it provides a much more honest picture of the company's long-term sustainability. Now, after we have discussed both the case for and against EBITDA, you may be wondering, how do I actually choose? And at least in my work with REITs, I found that the best approach, for me at least, is to actually stop picking a winner and to use both. So the NPI is kind of like the EBITDA of a single building. So just bear in mind that the caveat here is it's not exactly an apple-to-apple comparison, and they are definitely not interchangeable terms. So the main idea of NPI is that you take the rent collected and subtract all the direct operating costs such as maintenance fees and security expenses. So if you see a steady or perhaps an upward trend of the NPI, you can kind of conclude that the operational pulse of the REIT portfolio is strong. However, we cannot stop there because as REIT investors, we care most about dividends. And this is where Warren Buffett's side of the argument becomes vital. Even if the building performances are practically perfect, you need to remember that the REIT company itself has to pay back interest on its bank loans as well as its management fees. And these are real cash costs that sit right between your property income and your wallet. So once I've confirmed that these properties are healthy, I would like to then look next into the distributable income. Again, not interchangeable terms, but this is kind of like the REIT's version of bottom line profit or PAT, in the sense that it tells me exactly how much cash is left to be paid to shareholders, or in the REIT universe, they are called unit holders. So if you ever happen to find a massive difference between the net property income as well as the distributable income, this could imply that there could have been a massive bank loan interest to pay for, or a massive REIT management fee or whatnot that has been eating up most of the gains. All in all, I essentially get a clearer picture of the REIT by using both of the metrics. I use NPI to make sure that the properties that are under the REIT portfolio are of high quality, and then I use the distributable income to make sure that the company runs in a way that actually pays me. At the end of the day, The debate between EBITDA and profit after tax is more about knowing which questions you're trying to answer. EBITDA is your tool for checking the pulse. It tells you if the assets are doing their job today. On the other hand, your profits after tax, or PAT, is your reality check. It reminds you that costs like interest and replacing old gears are real expenses that can actually determine if your company will still last for another 10 years. So, when you're looking at these asset-heavy companies, try to study both metrics. Seeing that difference is usually what separates you from a lucky guess versus a smart investment. Till then, thank you so much for watching. If you enjoyed this breakdown, do consider hitting the like, subscribe and bell icon so that you don't miss any of my future deep dives. In the meantime, if you're interested in learning more about the other metrics that I use to evaluate REITs, do check out this video that I've made here where I discuss this particular topic. Appreciate you for being here, and I shall see you in my next video. Bye bye!